Welcome. My name's David Stone, Senior Manager in Veridan's Financial Service Practice Group. I'm joined by Megan Ruby.
Hey, David. It's Megan Ruby. I'm a senior in the financial services group here.
And thanks for tuning in for our second video of our Preparing Financial Statements video series. Hopefully, you've downloaded the checklist that accompanies these videos. We'll be walking through that checklist in more detail today, focusing on the balance sheet section. So, Megan, high level, what's the purpose of a balance sheet? What are we trying to accomplish here?
A balance sheet, it's really just a snapshot of a company's financials at a point in time. And it can be really useful, especially when used comparatively, to show the transition of where a company used to be at to where it is today.
Yep, spot on. I certainly agree with that. And, I also think a balance sheet's a great starting point, and we'll chat a little bit more about this in a minute, but to figure out, okay, what do we need to disclose further in the footnote disclosures? Your balance sheet can be a great starting point to determine what else you need in your full set of financial statements. So with that, let's jump into our checklist here. Megan, take it away.
So, David, we're starting off here at some of our basic accounting classes, but it's something that's really crucial to take a look at. So, ensuring that the total assets equal the total liabilities and equity. So, going back to that good old formula we learned at our young ages. And then going in a little bit more, what are these new line items that need to be disclosed separately? So typically, for assets or liabilities that exceed 30% of stockholders or members' equity, it's considered to be significant. And those are really the big things that we want to be reporting on the face of the financials.
Yeah, those are great points, Megan. Total assets equaling total liabilities and equity seems pretty straightforward, but as I mentioned previously, things change in the financials, and all of a sudden that equation doesn't work. Things don't balance. So definitely good to double check that, especially when you're at the end of your financial statement prep process. So jumping down to the bullet 3 here, and this really goes off of what I mentioned at the top of the session, but there are new line items that are added to your balance sheet. You want to think, does this have any implications on my footnotes? So, for instance, you need to add a paragraph or some description in your summary of significant accounting policies about that new line item. And further, does it need a separate footnote disclosure entirely to satisfy required disclosure requirements? And this is where referring to the accounting standards codification or even a disclosure checklist, if you have one handy, can be two really useful tools just to determine what, if any, are the disclosure requirements for those new line items. Now, you also want to consider, are there any new categories of borrowings that should be presented separately from other categories of borrowings? So, I think of recently with the Bank Term Funding Program that was available, we saw a lot of institutions break out those borrowings separately from other borrowings, such as, FHLB advances, for instance. And then lastly, consider if there are certain line items on your balance sheet that should agree to other disclosures. This is key. For those line items, you want to check for consistency with the disclosures. So again, comparing your balance sheet to the related disclosure, making sure that amounts that should agree actually agree. And you'll often find there might be some rounding errors, might be off by a few dollars. So this is a real common area where we find edits. So some examples can be cash equivalents, investments, your investments footnote. There's a lot disclosed there that should ultimately tie back to your balance sheet. Loans receivable, allowance for credit losses, a lot going on in those footnotes, especially now under CECL. Does that tie back to your balance sheet? And not only to your balance sheet, but even within the footnote itself. Are there amounts that should tie from one table to the next? And do they tie? Few other examples: premises and equipment, deposits, borrowings, equity. The list goes on. These are just some examples, some of the more common areas where we see numbers that should agree from your balance sheet to the footnotes.
Face of the financials are really just showing the big part of the story. And we just want to make sure that it's consistent and clear with a bunch of the other parts of storytelling that we have going on within disclosures. So making sure that what we're saying is true throughout. Well, thank you guys for tuning in to the balance sheet portion of preparing financial statements. We just want to hope that you guys get a lot of this, and we'll see you guys in the next section.